All right, today we are jumping headfirst into a company you've probably seen a million times, Public Storage. We're going to get into the weeds, figure out what makes this business so dominant, and then answer the big question. Is it actually a smart place to put your money right now? Let's do it.
And really, this is the entire reason we're here. There's no doubt that Public Storage is a fantastic business, a real titan in its industry. But, and this is a huge but, a great business doesn't automatically make for a great investment. Price matters, and that's exactly what we're here to figure out.
So, first things first. Before we can even begin to talk about what this company is worth, we have to know exactly what it does and how it makes its money. Let's start at the very beginning.
Okay, so Public Storage is what's called a REIT. That stands for Real Estate Investment Trust. The easiest way to think about it is like a mutual fund, but instead of stocks, it owns physical properties that generate income. Their main job is to own buildings, collect rent, and then they have to pass most of that income along to shareholders in the form of dividends. And when you boil it all down, their business model is just beautifully simple. They find good spots, they build or buy these big storage facilities, and then they rent out the little orange doors to people like you and me. You really can't get much more straightforward than that, right?
So, what makes this such a resilient business? Well, think about it. The need for storage isn't based on some hot new trend. It's driven by major life events. The 4 Ds, as they're sometimes called: death, divorce, downsizing, and dislocation. These things happen whether the economy is booming or busting, which gives Public Storage this incredibly reliable, recurring stream of revenue.
All right, now that we have a feel for the business, let's really put it under the microscope. We're going to use a classic SWOT analysis here to get a full 360-degree view of where the company stands today: the good, the bad, and the ugly.
So let's break this down. On the strength side, it's a powerhouse. You've got that iconic brand, they own fantastic real estate in prime locations, and they make huge profit margins. But look at the weaknesses and threats. The business is super sensitive to interest rates, which is a major threat in today's world. And while there's a huge opportunity to buy up smaller competitors, there's also the constant threat that too many new storage places get built, which could totally crush their ability to raise prices.
And this right here is where the rubber meets the road. We've established it's a high-quality company, no doubt. But the million-dollar question is, what is it actually worth? And how does that number compare to the price tag on a share today?
To figure that out, we have to talk about something called intrinsic value. Now, this is not the same thing as the stock price you see flashing on your screen. Think of intrinsic value as our best guess of the company's true underlying worth, based on all the cash it's expected to generate for the rest of its life. It's our analytical North Star.
And whoa, this slide tells a very interesting story. The analysis pegs the intrinsic value at around $258 a share. But as of today, the market price is sitting way up at $292. That is a pretty big gap. It means the market is paying a hefty premium over what the analysis suggests the business is fundamentally worth.
That gap brings us to maybe the single most important concept in investing: the margin of safety. It's the buffer you have between that intrinsic value and the price you actually pay. I love the analogy of a financial fire escape. It's the cushion that protects you if you're wrong about the future or if the world throws the company a curveball.
So let's put it all together. With an estimated value of $258 and a price of $292, what's our margin of safety? Well, as you can see, it's 0. In fact, you could argue it's actually negative. You're not getting a discount, you're paying extra, which means you're taking on all the risk yourself with no cushion whatsoever.
Okay, so if we don't have that safety net, we really need to be crystal clear about the risks. What are the potential storm clouds on the horizon for Public Storage? The big 3 risks are pretty clear. First, interest rates. As a real estate company, higher rates are like kryptonite. They can really hurt property values. Second, overbuilding. If everyone and their brother starts building new storage facilities, you get a glut of supply and prices have nowhere to go but down. And finally, a classic economic slowdown. People lose their jobs, that extra storage unit is one of the first things they'll cut from their budget.
So, what's the road ahead look like? Well, nobody's expecting this company to suddenly start growing like a tech startup. The outlook is for slow, predictable, steady growth. This is really an income story. The main reason to own it is for that stable, reliable dividend check it sends out.
Okay, the moment of truth. We've looked at the business model, we've run the numbers on valuation, and we've sized up the risks. It's time to put it all together and come to a final conclusion. The source material could not have been more clear, and this quote says it all. The analysis found that even at a lower price of $272, the expected annual return was less than 9%, which failed the minimum requirement. Now think about this. With the stock price even higher today at $292, that expected return is even lower. That makes the investment case look pretty weak.
So the bottom line from the analysis is pretty blunt. For anyone thinking about buying, the verdict is to avoid it. For anyone who currently owns it, the recommendation is to sell. The price is just too high to offer a decent return for the amount of risk you're taking on.
Let's just quickly recap what we've learned. Number 1, public storage is a fantastic, high-quality, durable business. No one's arguing that. Its advantages, its brand, its real estate are top-notch. But, and this is the most important part, the current price is just way out of line with its estimated intrinsic value, and that means there is absolutely no margin of safety for new investors today.
And that leaves us with this final, crucial question to think about. Is a great company always a great investment? The case of public storage today shouts the answer loud and clear. Absolutely not. The quality of the business and the price you pay are two totally different things, and confusing the two is one of the easiest ways to lose money in the market.